All right, we begin here in Nigeria. Central Bank Monetary Policy Committee raised the benchmark rate by 100 basis points to 17.5% in its first meeting of 2023. Central Bank of Nigeria Governor Godwin Emefiele announced this while speaking to journalists after the two-day MPC meeting that began yesterday. He also insisted that the January 31st deadline for the phasing out of old Naira notes is sacrosanct.
The committee therefore decided to sustain the current stance of policy at this point in time to further rein in inflation aggressively. One member voted to increase the MPR by 50 basis points, 4 members by 50 basis points, and 7 members by 100 basis points. In summary, MPC voted to 1. Raise MPR to 17.5%, 2. Retain the asymmetric corridor at plus 100 and minus 700 basis points around the corridor, and 3. Retain the CRR at 2.5%, and 4. Retain the liquidity ratio at 30%. I must say here that unfortunately I don't have good news for those who feel that we should shift the deadline. My apologies. The reason is because, just like the president had said on more than 2 occasions, and even to people privately, that for us 90 days, in fact, we feel is 100 days is enough for anybody who has money or the old currency to deposit it, the money in the banks. And we took every measure to ensure that all the banks were open or remain still open to receive all old currencies. 100 days, we believe, is more than adequate.
All right, there you have it. That's the Central Bank of Nigeria Governor Godwin Emefiele. Now, the House of Representatives in Nigeria has asked the central bank to give a 6-month extension for the implementation of the new Naira note policy. Lawmakers are also inviting Central Bank of Nigeria Governor and the bank MDs to appear before its ad hoc committee following claims and counterclaims of insufficient new notes in circulation. And speaking of rejecting new notes, we got some news coming from the Bako local government area of Niger State. A family requesting that old 1,500 Naira notes that their suitor's family had presented as a bride price be returned. The wedding was not postponed. The girls' guardians reportedly stated that they required the new notes because they'll be unable to deposit the money in a bank account because of that central bank deadline of January 31st. Now, the central bank is trying to move across the rural areas to make sure that the new notes are there. It's begun a cash swap scheme in all of Nigeria's local government areas as part of measures to facilitate the use of its new Naira notes. In a circular sent out to all deposit money banks, mobile money operators, super agents, and agents, the bank said, or rather made this information known. The cash swap initiative, according to the CBN, is a collaboration between super agents and deposit money banks located around the nation. The super agents are firms that the CBN has authorized to hire for agency banking. Let's bring in our panel to get started on this discussion. We've got Joshua Adebisi, who's a sub-Saharan African banking analyst with Vetiva Capital Management. And also, we should have Damilola Akinbami, who, of course, is a senior manager with clients and industries at Deloitte. Thank you both for joining us. Good afternoon. Dami, let's start with you. Was this a surprise? Because I was surprised. I thought they were going to hold the rates. Did you expect this latest rate hike, Dami?
Good afternoon, Rotus. Thank you for having me. I actually had mixed feelings. I was more on the fence in the sense that, one.
Oh, looks like we got frozen there with Dami. Let's hopefully reconnect with her. All right, Joshua, let's bring you in. So Dami said she had mixed feelings about where the rates were. She said she was sitting on the fence. Were you on the fence? What did you expect as far as this rate hike is concerned?
Well, actually, we were more inclined towards them holding, simply because we saw that they'd been quite aggressive towards the end of the year, and we thought that with the inflation coming down in December, maybe they might just back off a little bit. But I think that that didn't really take into account the fact that they're looking ahead to the fact that probably fuel prices are going to continue to go up, so there's going to be a lot of pressure on inflation, and so they're trying to preempt that by continuing to raise hike.
It's interesting you mentioned fuel. We still have fuel scarcity, and apparently I think Abuja-Kaduna rail line is shut down now because of inability to access diesel. What does this do to borrowing costs, Joshua?
Well, obviously, 100 bips, 1%, that's just further raising up borrowing rates. But at the same time, I think that it's not a material change because borrowing rates were already going up, across both the primary and secondary markets. So it's just a continuation more than anything.
Okay, now, so borrowing costs are still going to remain high. You mentioned inflation decelerating in December. Are the rate hikes working, or is this as a result of other factors?
Well, there were a number of factors that were responsible for that particular deceleration in December. So I wouldn't say that we can definitively place all the, blame or glory on the rate hikes as of yet, because these things tend to take quite a little bit of time. Hence why the CBN is continuing to even raise rates as we speak. So I think that more than anything, what we've seen is that inflation in December, you could boil it down to, high base effects from December of 2021 and a number of other issues. Pretty much fuel costs, energy costs, transportation costs were a little bit stable around that time, but obviously the scarcity has persisted, and so that has probably put more pressure back on inflation going into January and probably factored into why they decided to continue raising rates. You know what,
let's actually, since fuel keeps coming up here, what do you make of this? Diesel is deregulated, right, but yet maybe it's a price issue, and we've had one rail headline after another. I think last week the Warri Takpe train derailed somewhere around the Kogi forest. You had the march last year, people were kidnapped, and now we're hearing that this Abuja Kaduna line, that they don't have access to diesel. Joshua, since we keep talking about fuel costs and how this feeds into inflation and so on and so forth, what do you make of this particular issue here?
Well, so it's quite a difficult one, because obviously we're sort of waiting on the edge of our seats for a solution in the form of, the Dangote refinery. But the truth is that at the same time, we've always had issues with regards to diesel, or most especially PMS. Despite the fact that the diesel market is deregulated, why are they still struggling to get access to the product?
It's puzzling.
Yeah, it's absolutely baffling. But, at the same time, there's still hope that some of the modular refineries in the south, as well as the Dangote refinery, will come and ease some of that pressure. The unfortunate thing is that we're not sure how long that will take, even if the Dangote refinery comes online, before it starts, running and actually pumping out the amounts that will satisfy the entire country and be able to export. It might take quite a number of months. And so if we're still relying on the really beaten down infrastructure to maintain supply at this moment, then I think we're going to struggle with this for in the near term, a few more months.
Yeah, thank you. See, that's why we have you, folks like you and Dami on to tell people the honest truth, because a lot of folks keep talking about refineries like they're just going to flip around tomorrow and all of a sudden you just have supply everywhere. And that's the Dangote refinery is brand new.
Right.
Not to talk of the old, aging, almost dead refineries that people keep thinking will just turn around overnight. Thanks, Joshua. Okay, I think we have Dami back. Dami, please continue with your point, your take. You said you were sitting on the fence with respect to the MPC decision.
Yes, as I was saying, I was sitting on the fence in the sense that, there's the argument for them to maintain status quo, bearing in mind that, there's an election that is occurring next month. So one would think, okay, let's maintain status quo. Let's see what the outcome of the election would be. And then depending on the new government, we could now decide on whether to continue with the tightening stance or maintain status quo. And also there's the argument in favor of let's maintain this momentum we have sustained or carried over since May 2022 when they started increasing interest rates. Because, to an extent, we've seen that this increase in interest rates are beginning to bear marginal fruits in terms of, what we are seeing in liquidity stance. However, based on the fact that, one, you are sending the right signals to investors. Two, also, we saw that marginal dip in inflation in December. One would expect them to also consider the fact that let's continue tightening now, considering the fact that we don't even know how the elections will pan out and what the outcome would mean for monetary policy stance. So I think in general it was a good call to make. 100 basis points increase to 17.5% in the MPR.
All right, thanks, Dami. So we were also talking about inflation. And Jami, I'll throw this question to you. Let me start with Joshua. Joshua, how do we get inflation down? You know, how do we get it down here?
Well, obviously, the CBN is doing their own side on the monetary side. The truth is, we need strong fiscal policy as well, right? And I think that that's really where we've dropped the ball generally, because this rise in inflation is really being caused by, high energy costs, high transportation costs, and those things can really only be solved with increased or improved infrastructure, to be fairly honest. Because if we could solve those issues, then they would have a trickle-down effect, if you think about it. Transportation costs were solved, or cost of transportation was improved, then food prices would improve as well. Same thing with electricity. All these things are purely down to infrastructure. Unfortunately, there's no quick and easy fix for that, right? These are structural issues that have been there for quite a long time, in my opinion. I mean, everybody can agree that the rate of improvement in the energy sector is nothing to write home about. And I think that that's really where we're seeing the biggest roadblock to actually improving the general economy, because that's where you actually boost productivity as well. Because if you have a more productive society or a more productive economy, then that could also help to improve our balance of payments as well. Because on top of everything, we're not also exporting as much as we should have. Because another aspect of the entire argument is that our FX inflows are just poor. And that also comes down to our crude oil production. So again, if we are able to solve transportation, crude oil production, electricity, all these things are really linked to each other, then we wouldn't be in this position. Because, the pressure on the FX reserves alone for the last 1 year has also added to the inflationary pressure. So I think that those are really the biggest issues. Unfortunately, I don't think that there are quick and easy fixes for any of them.
And this is right before a crucial presidential election where the Nigerian populace is expecting whoever comes in to just fix this stuff pretty quickly. Dami, do you agree? What's your take on how we bring inflation down?
I think, first of all, you need to understand the fact that for Nigeria, what is driving inflation is not necessarily demand pull, it's more of a supply shocks effect. So interest rates hikes, that is a necessary condition, but it's not sufficient. So for Nigeria, you need both your monetary policy, you also need fiscal policy to complement it. Bearing in mind that, for instance, now the ways and means advances, which is what the federal government is borrowing from the CBN, is about 22 trillion now. So you have monetary conditions such as that being accommodative, which obviously would contradict the impact of your policy tightening stance. You also require a mix of other investment policies, trade policies. So for instance, now in Nigeria, now we've seen that decline in the level of investment flows into the country for various reasons, policy uncertainty, insecurity, and what have you. So for you to be able to bring down inflation, bearing in mind that you have a production issue, you have an infrastructure issue, you have supply chains disruptions, you have the demand pull money supply issue. So you can't just use interest rates alone to bring down inflation. So I think, you need to look at how you need to boost productivity, how you need to increase aggregate output, and that would require you also bridging the infrastructure gap, because once you can increase aggregate output, then consumer prices will decline. You are employing your people, you are creating more jobs, so that also would increase labor productivity, and at the end of the day, factor productivity. All these things have a multiplier effect when combined together, and you would see that your consumer prices will start to decline.
All right, thank you for that. Thank you, Dami. Joshua, back to you. Do we expect to anticipate more rate hikes from the MPC going forward then? I guess maybe in the near term.
I think it all purely comes down to what inflation does in the coming months. So if energy prices stay up, I'm anticipating that we're going to continue to see PMS prices rise steadily. And if that happens, then probably there will be significantly higher pressure on inflation continuously, and then in that case, the CBN will only be able to respond by hiking rates, especially if the developed markets, your US or your EU, continue to also hike rates as well. If they do that, then we're going to have to respond in kind, because that's going to cause, well, there's already been a bit of a capital shift towards that market, but it would just exacerbate it further. And so we would try to counteract that by also raising our own rates to make our market more attractive.
Interesting. And then, of course, we've got possible subsidy allocation ends in June. So there's a 30-day clock for the new administration. It's all so fascinating. It's also fascinating also over the next 30 days. Thanks, Joshua. Dami, is monetary policy alone effective, or you need fiscal support as well?
Rhodes, I think I already answered that in my last response, where I talked about a cocktail of policies being required, that at least, especially if you have a situation like Nigeria, where inflation is not predominantly driven by demand pull factors, it's more supply chain disruptions and shocks and cost push factors. So definitely monetary policy is necessary, but it's not it's not sufficient. So you need to combine it with a cocktail of other policies, investment policies, address your infrastructure gap, look at the fiscal policy, address your debt servicing issues, because we're talking about the increase in interest rates, both in Nigeria, regionally, and globally. So that has significant implications for a country like Nigeria that is planning on increasing its borrowing. There's nothing wrong with borrowing. I mean, even the US, it's talking about the fact that their borrowing levels are reaching record levels right now and all that. It's what is of more concern is the fact that they are raising more funds at a time where interest rates have increased. So the cost of servicing that debt becomes more excruciatingly painful. And so if, for whatever reasons, investors perceive that you stand the risk of defaulting on your debt, then they become more jittery. We start to have more credit rating downgrades. Remember that in last year, Nigeria was downgraded twice by Fitch and Moody's. So by the time you keep having that will even make it more difficult for you to access international debt. And that obviously would affect your debt profile, the perception investors have about you. So, I mean, at this point in time, it's very tricky, especially with elections coming up. So I think at this point, I mean, the focus obviously is more on politics and election than economics and policy. And when the new administration comes in, typically there's this increased energy to hit the ground running. So we expect that if the administration that comes in comes with that mindset, they'll be able to ride on that momentum and implement the necessary policies required, because timing is everything. If you can hit the ground running and implement the policies required, then you have ample time to see the effect or the impact on the market. And if you now need to adjust your stance and be flexible in whatever way, because you have to be dynamic in your response, because the market is dynamic, then I think, I mean, to an extent, we should be able to see inflation towards the year stabilize, and possibly maybe even see a status quo being maintained towards the end of the year if inflation is brought under control.
All right, thanks, Dami. Very interesting that you mentioned the U.S. I hear Democrats are pushing to eliminate the debt ceiling in the United States. Interesting development there. Thanks, Dami. Joshua, let's talk. In fact, for the both of you, let's talk Naira redesign. And there's been, I mean, you've got people rejecting bright prices and old notes. I heard Cold Stone, the restaurant, they put out a tweet saying that they weren't going to accept any more old Naira notes as of the 27th, I believe. You've got the House of Representatives asking for 6 more months in order to extend the deadline for the Naira notes shift. And of course, we've had the central bank governor, Godwin Emefiele, saying that is not going to change. The date is where it is. Joshua, what do you make of all the reactions from bride prices to restaurants to everything else? What is this? Is this part of the process of the transition, basically?
Well, I mean, it was always inevitable when you have such a small window for such a big policy, right? I think that, I mean, I was always very certain that they would resist any possible extension of the deadline, simply due to the fact that the objectives have been clear from the very beginning. And the whole idea was to get this done ahead of the election, right? So any talk of pushing the deadline by 6 months, it's not going to happen. And the truth is that the central bank governor has the full backing of the president, so it's going to stick, I think. Now, the reaction from the public is to be expected. The closer you get to that deadline, the more of a panic there will be, because they're realizing that, oh, we need to get this done. If not, this money will turn to worthless paper in a few days. So the only issue I have is that in the rural areas, right, there has been, I cannot imagine the people who live miles and miles away from any bank branch, right, have been able to have access to that. But the CBN says that they're fixing that, or they're going to, start going there directly. I mean, that's what they should have done from the very beginning. I don't know why they waited until a few days before the deadline to enact that policy. That should have been done from the jump. But at the same time, I think that it's just going to cause a lot of chaos. We've seen this before. We've spoken about the fact that when India did this, they didn't even try and achieve such a short time frame. The turnaround is too small. But I guess it's something that has been set in motion, and we're going to have to live with the consequences of that.
Thank you so much for that, Joshua. Dami, have you got access to any of the new Naira notes?
Unfortunately, I have not been able to access any of the new notes. I think the time frame is short. If you even look at the UK, they did something similar. That was, I think, either last year, this year. And I mean, you would have at least like 6 months to a year to allow the public, exchange or swap their old notes for the new notes. So the time frame, in my own opinion, I think it's quite short. The CBN governor has said that the deadline remains. So we're definitely going to see that scramble and panic towards as the deadline gets closer. But I want to believe, one way to address this would be for, the banks to have more access to this new note, so that, when people go to the ATMs, when they want to withdraw, they can get the new notes. When they go to their banks, they can easily get the new notes. Because I think the issue right now is the volume of new notes that are available might not be sufficient enough to meet the demand out there. And in terms of the cash swap, and I think it's just part of the CBN's financial inclusion drive, which at least carrying the rural areas along. But I think it goes beyond that. Proper communication, ensuring that the necessary tools are in place would allow for this kind of reform or this kind of policy to be effectively implemented.
Thanks, Dami. Okay, Dami mentioned financial inclusion, Joshua. And Dami, I'll come back to you with the same question. What about the electronic side of things? Does this push people more to use debit cards to do transfers? We've seen the NIBS numbers. I can't remember what it is, but I think it's up year on year, 40 to 50% in terms of the number of electronic transactions from POS and so on that we've seen. So does this somehow push us more in that direction?
Yes, I think that was also part of the objective. Now, the truth is we've got to understand that there's a little bit of a separation between the urban, more developed areas and the rural, far less developed parts of the country, right? Even if we want to move towards a society where we're all using mobile, digital, USSD to conduct our transactions, and that's great. The truth is, until you have mobile and digital penetration at close to 90%, there is always going to be some sort of exclusion. And that is really my biggest concern. Because what we're doing is, Ernest, it's objectively correct. But the problem is you're not carrying everyone along, because not everyone has access to these same tools. Not everyone has access to the internet and can do their transfers online. Not everybody has access to even POS machines. Right? When we go away from the developed Lagos, Abuja, Port Harcourt, wherever, and you go into the more rural areas, you don't even have to go that far to find places like this, where, like I said, there aren't even any bank branches, right? Where people have to literally come together and send one person who has a BVN or whatever on his way to the bank, and he will make a long journey just to go to the bank and do transactions for an entire community. At that point, what exactly are they supposed to do? Right? Because remember that there are also exclusionary factors such as the BVN, the NIN, and those things are linked to phone numbers, and you need a phone number in order to access your account or to open an account. And then when you open an account, then you can use USSD. So if you don't have all these tools, you can't even open an account, right? So a lot of people are still doing transactions the most traditional way possible, which is cash, right? So until you're able to bring those people into the fold as well, then there's always going to be an excluded population. And I think that those issues have not really been addressed yet. I think that that's really where the focus needs to be. I don't know how. Again, I'm not a policymaker. That is down.
It's not easy.
Yes, it's not easy. But the truth is that all these policies, I feel like sometimes they are being implemented or being thought of in a bubble, right? If you are not thinking about, or you're not carrying along the most excluded members of society, then there's a long way to go. I think that's how I see it.
Thank you for that, Joshua. Dami, where do you stand on the push towards the electronic side of things? Does this get us there, I don't know, faster?
Definitely one, I mean, you see that improvement in terms of electronic transactions. But what I would just want to focus on is, I mean, like the issues that Joshua raised. So what are the solutions? One, it would be definitely there has to be investment in the infrastructure required to bring these financially excluded people into the fold. So Joshua mentioned phones and what have you. So basically, the infrastructure required. And I'm not even talking about high tech and whatnot. Definitely, we need all that. But first things first, you have to start from the grassroots, from the basics. So do they have access to normal phones? Not necessarily smartphones. You don't need smartphones to be able to carry out certain financial transactions. So things like that, making such resources available to them in the rural areas. Then communication also. I like the fact that Joshua too mentioned that you also need to be able to properly communicate, because one thing with Nigeria is that a lot of policy reforms are announced, but communication, the way this information is communicated to the public, needs to be looked into, because once there's miscommunication, it creates room for all sorts of interpretation. It's subject to people's interpretation and whatever. So I think for me, the focus should be, okay, fine, you have this policy in mind, you have this drive, you have this objective. How do you go about achieving it? First thing is you have to ensure that the necessary tools to achieve these things are made available. So I think, that infrastructure part needs to be addressed for you to be able to benefit from it. But in the long run, definitely we're going to see an increase in electronic transactions and that gradual shift away from cash. The more developed locations, the urban cities, and by urban cities I mean more like Lagos, because if you go to a state like Oyo State, Ibadan City right now, it's still a heavily cash dependent society. So there has to be, obviously you're not going to expect the whole 36 states to move at the same pace. Definitely some would be more advanced than the others. So you need to be able to carry everyone along, ensure that the right information is passed across, make sure that the necessary infrastructure, resources and tools required to achieve this goal are being provided across board. And I think we will get to that level where at least, even if we're not 100% financially included, we would have at least a 90% financial inclusion rate.
Well, amen to that. Kenya is currently at 80%, 8 out of 10 Kenyans financially included. Damilola Akinbami, Senior Manager, Clients over at Deloitte, and of course Joshua Debisi, who of course is a Senior Sub-Saharan African Banking Analyst with Vertiva. I thank you both for joining us to talk about the monetary policy, the hike in interest rates, and of course a number of other issues, of course chief being the cash deadline for the old notes, so switching over to the new ones January 31st. Thank you both for your time. Really appreciate it.